It's way too early, I think, for anyone to be expecting the central bank to be saying, we feel safely on the track towards 2%. No. I think even at the review later on May 24, that could even still be a bit too early. Hello, everybody, and welcome back to another edition of Tea with Tony, without any actual cups of tea, brought to you by NZHL. Now, for this month, I've been asked to have a look at three particular things out there. One is going to happen any day now. That's the April 5 review of the official cash rate by the Reserve Bank. So that's monetary policy, interest rates going up and down. Secondly, maybe just make some brief comments about the flooding research done by the Reserve Bank recently and the degree of exposure of New Zealand banks there. And number three, the state of the housing market in New Zealand, because if you have got any friends out there who are real estate agents, you're probably aware that they're not necessarily all that busy at the moment. Not too many people as yet going through the open homes. So have a look at what some of the underlying factors are there causing the current low level of interest in residential real estate in New Zealand. But do what is essentially my job as an economist: step back from all the little ups and downs and twos and fros and sometimes even the cycles there to see what the bigger trends are. And that's what I'm going to finish up on. There's certainly a bit of a building up of some factors out there which at some stage, and frankly none of us know exactly when this is going to be, these things will come to the fore and we'll see the cyclical upturn in the housing market come along. So just a reminder, if anybody's actually got a question they'd like to ask me, by all means just send me an email at tony@tonyalexander.nz and we can go from there. So let's just have a look at that first thing then, the Reserve Bank's monetary policy. This was the big thing on November 23 last year when the Reserve Bank increased their official cash rate by a record 0.75%. They warned of a recession coming along in particular, and that scared the bejeebers out of people. And those two things, the talk about recession, the increase in the interest rates in response to the higher than expected inflation, certainly had a big impact on all of the confidence measures which I gauge, ANZ, all other sort of operators, etc., out there. And it's had a pretty definite impact in the real estate market as well, which I'll talk about later on. Now, the Reserve Bank on February 22, they increased their official cash rate again by 0.5%. And when they did that, the expectation of pretty much all of us was that come April 5, they would increase by another 0.5%. That's not the expectation now. Now the common view, including for myself, is that they'll only go up by 0.25%. Now, what is it that's changed over this period of a few weeks' time? Well, of course, it's the developments in the banking sector in the United States. The collapse of SVB, Silicon Valley Bank, in the United States has sent a bit of a bout of nervousness around the world's banking markets, the financial markets, and people wondering, well, which bank is going to be next there. Now, as I pointed out in my weekly videos, this is not because of bad lending. It's because of bad depositor policy management by this particular highly specialized institution and a couple that look slightly similar to SVB as well. It's not a generalized thing as the Asian financial crisis was, 97, 98, and certainly not the global financial crisis of 2008, 2009. And just over this most recent 7-day period, we have seen the market settle down with the central banks having taken some pretty strong actions to make sure banks remain liquid and depositors can see that they are liquid, because that's what's driven this, the fastest depositor run on a bank that's ever happened in human history, because it was all done by tech savvy people twittering to each other and moving money, as we all can do electronically, very swiftly these days. Now, because of just a little bit of concern about the banking sector in the United States predominantly, and a little bit the UK and in Europe as well, the expectation around the world is that banks are going to pull back a bit on their willingness to lend. That means less credit creation in economies, less economic growth, less inflationary pressure. So the key point to note here is that the troubles with SVB act like a tightening of monetary policy. They're having pretty much the same effect as if monetary policy had been tightened. And so that has led to quite a decline in some interest rates, in particular in the United States. Their 2-year main interest rate has dropped by about 1%, and there's about a 0.5% decline in their 10-year US Treasury bond interest rate as well. We've seen some declines in New Zealand, not to the same degree, but certainly some decent declines have come along. Now, people might be thinking with the negative commentary I've already made and going to make a bit more on the state of the housing market in New Zealand, some worries about the world economy, etc. Again, why would our central bank still be increasing interest rates? Well, here the important thing to grasp is that we've still got inflation at 7.2% in New Zealand. When you look at measures of inflation expectations, what you and I, what business people think inflation will be in a year's time, they're still absurdly high, about 5.8%, I think is the one still being run there monthly by the ANZ Business Outlook survey, for instance. Plans for businesses to increase their selling prices. Of course, businesses are under extreme cost increase pressure. Those plans are still very high. So the Reserve Bank is still fighting against high inflation expectations. There's also a boost to inflation, of course, going to come along as a result of the recent extreme flooding events. Even before Cyclone Gabrielle, Treasury had estimated that just the flooding in Auckland would add about 0.4% to the country's rate of inflation this year. So that is going to delay the timing of inflation falling away and everybody clearly seeing that we're on a good solid track, back towards 2% or so. We've also got to remember that the labour market in New Zealand is still very tight, and this has been my key point pretty much since about 2005 in New Zealand. I've written about this in my most recent Tony's View publication as well. For almost 2 decades, I've been hammering home to businesses that this is not just a cyclical tightening of the labour market in New Zealand from pre-GFC and then post-GFC and then over the past couple of years as well. This is a permanent structural change and businesses need to get used to it. The positive thing, of course, is for householders, people have good job security. And for the moment, what it means is there is very little chance that the Reserve Bank's prediction of the unemployment rate in New Zealand going to almost 6% will prove correct. They'll be lucky if we get it above 4.5% or so, given the shortage of labour which we've got in our economy. Also in Australia, also in the United States, the UK, even in Europe as well. So there's still some underlying strong inflationary pressure, 0.25% increase from the Reserve Bank, and it's way too early, I think, for anyone to be expecting the central bank to be saying, we feel safely on the track towards 2%. No. I think even at the review later on May 24, that could even still be a bit too early. They'll have a full set of economic forecast updated by then. May 24, we will also know what is in the government's pre-election budget of about 5 or 6 days earlier than that. So that's going to be quite an interesting one further out. Now, I said I'd just make some quick comments about some recent research the Reserve Bank did, noting that about 12% of the home loan portfolio held by New Zealand banks related to houses which are in flood zones, not necessarily down the bottom of a gully, but when you get a decent flood and the floods sort of spread out a bit, that those homes are exposed to that, and about 2.5% of the portfolio exposed to homes at risk of sea level rise, bringing some inundation as well. Now, the key thing I think to note here is that around the world we have governments, local councils, etc., identifying areas at risk of floods, at risk of inundation from sea level rise as a result of the climate change which is happening strongly all around us. The awareness of it is growing, and it's a question then of when does this awareness actually get factored in to the prices of these properties. And it has to be said that so far the evidence from overseas is that it's a really slow process. There's some retreat from inundation areas, but it still seems to be relatively limited, and there still seems to be no shortage of people willing to essentially take the risk of buying on a waterfront because it's a nice view out over the river, nice view out of the ocean, etc. The key trigger most of us look here is looking for when the insurance companies say, look, we simply can't afford to be insuring these properties, or we can insure them, but the premiums premiums are going to be absolutely through the roof. We're already seeing some elements of that in New Zealand, but it seems relatively mild so far. And that, of course, is what's important for banks. Banks are only going to extend a mortgage if there is insurance on the property. And once we get the insurance companies pulling back, then, well, the mortgages are not going to flow. Some people who are cashed up may still buy the properties, but of course, most properties in New Zealand are still bought, of course, with a mortgage. So it's going to be the passage of time, and it's going to be maybe the frequency and range of impact of future inundation events, which is really going to be the driving force here as well. So we'll just have to wait and see how that plays out over time. Now, third area to look at there, of course, are the housing market in New Zealand. And the key thing to note there is that with the November 23 monetary policy shock delivered by the Reserve Bank, quite rightly, they've still been catching up on overstimulating the economy during the pandemic. Just the same thing happened in Australia, United States, UK, etc. And so we've had the big shock from November 23. People have pulled back from consumer spending. People have pulled back from the housing market, and over January and February, the number of dwellings sold by licensed real estate agents around New Zealand was at the lowest levels on record since those records started in 1992. So things definitely relatively weak there, and of course prices still falling as well. Now, for the next few months, it seems highly reasonable to expect that turnover is going to still remain low and that prices are going to go down further, with business consumer confidence surveys still showing a high degree of concern, of pessimism about the New Zealand economy generally. The interest rates, of course, are at still above average level, and you've got people like myself talking about monetary policy still tightening further in New Zealand. Now, let me just note something important here, that when we're talking about, or the media especially, are talking about people rolling off a fixed rate of 3.5% into 6.5% or something like that, people often make the mistake of translating that directly through into whatever the residential real estate market is going to do. But the key point to note here is that if a person has got their interest rate jumping sharply from 3.5 to 6.5, they already have a house. They are probably not in the market for another house. That's not the buyers. What's relevant to the buyers is the fact that the 6.5% rates are already out there. They've been there for a while. And what we can see as a result of the Silicon Valley Bank collapse in the United States is that expectations for interest rates going higher have been pulled back. And I might have mentioned this a month ago. People are scraping off the table their fears that interest rates are going to go to extremely high levels. And in particular, this is important for the first home buyers who we can see are back in the residential real estate market. Now, my monthly survey of real estate agents with REINZ at the end of January showed a net 3% of agents were seeing fewer first home buyers. So there we go, at the end of January. At the end of February, a net 22% were seeing more first home buyers, so quite a turnaround. And my most recent survey, and I've got almost all the results in now, I've got some analysis to do over the weekend, it's still a net 20%. Now, this is interesting. We still have the first home buyers in the market, despite all the discussion about SVB, some of the new ructions in the banking markets overseas. That has not disturbed the level of interest from the first home buyers in the New Zealand real estate market. And yet, at the same time, we have actually an improved interest rate outlook in New Zealand. So I'm not trying to say that, SVB going under is positive for New Zealand's housing market, even though in the past, sometimes that's how things have turned out. But I don't think it really disturbs what's on track for here in New Zealand. Question, of course, is, are the investors going back in? No, there remains zero sign of the investors stepping forward to buy. Election later this year, which looks like a toss of a coin for who's going to win, quite frankly. The interest rates still at above average levels, and of course the tax changes made a big impact on investors willing to buy at the end of March last year, and that remains the case going forward as well. And for the owner-occupiers buying and selling in the same market, with consumer confidence still so fairly bad, I don't think it's reasonable to expect they're going to be stepping forward for a while. I'm still running on the general view that the market's going to be bottoming out towards the middle of the year. It might be something immediately pre-election, especially because I think even once we get into the depths of winter/middle of the year, a lot of people are going to go, yeah, I might be looking to do a thing with my business, my home finances, but I'll wait until the election's out of the way. It's what we do every 3 years. So don't be thinking that there is some imminent turning of the market coming along. But I'll just reinforce my main point for some time, and I think this is one reason or a number of reasons why the first home buyers are in the market. There's no competition from the investors. There's a big range of stock to choose from. The vendors, while they're not falling over themselves to sell, they've still got jobs and wage increases, etc. They're a little bit more willing to negotiate and accept conditions in the offer as well. So still some weakness coming along for the next few months in the real estate market. But if I personally were looking to buy my first house and I was in a financial position to do so, I would be in the market looking, like I say, with very few other people necessarily doing the same thing. I just want to finish off very quickly here. Like I say, as an economist, my job, especially when we get these very uncertain times we are still clearly living through, none of us have been through a post-pandemic environment before, so that's a massive disclaimer for anybody's forecast, essentially, of anything on the planet at the moment. You've got to keep an eye on some of the longer term factors, and that's just a simple list I'm going to run through here. Number one, migration has an impact on New Zealand's housing market. We're now at plus 33,000 net gain, and we're heading to something higher. That's going to show through at some point. Number two, I'm still of the view we've seen the peaks in the fixed mortgage rates a couple of months ago. I don't think the track down is going to be rapid at all, but that slowly is going to feed through, I think, that view there. Number three, as each month goes by, there's a backlog which grows of people who want to buy but go, yeah, nah, and they're waiting a little bit for something to happen. So that's also significant. Number four, the distinct characteristic of this period of economic challenge, high job security in the New Zealand economy. Five, there is wages growth. We've got one of the most deregulated labour markets in the world. Wages are responding, so that's positive. And this is double-edged sword. Construction falling away. All the anecdotal feedback I'm getting from the construction sector is that things are going to be dropping away quite a bit from later on this year, and so new house supply growth will be slowing down from later this year. You put that in a supply-demand curve alongside accelerating population growth, and you can figure out your own implication what there is there for house prices over the medium to long term. So look, I hope you found some of that information there informative. This is still a fairly liquid, uncertain environment that we're living through. And let me just give the disclaimer here that the views I've expressed are my own personally, not necessarily those of NZHL. And just keep in mind, not a single person on the planet got just about any of their forecasts correct when the pandemic came along. So just keep that in mind, that none of us have been through a post-pandemic environment before either. So be prepared for goodness knows what other surprises could come along over the next few weeks, months, the rest of 2023. All the best.